Hi, good afternoon, everyone. We will begin our monthly market outlook. Next slide, please, Avinash. If you look at the global economy, the money printing by G7 central banks continue. It's now at about 834 million per hour for last 18 months. With money getting printed so easily, people are investing in financial assets, and equity and debt as a percentage of global GDP is at all-time high level. Undoubtedly, global market capitalization also is at all-time high level. More importantly, corporates are sitting on huge cash in their balance sheet, aggregating to trillions of dollars. Some of the big companies like Apple's cash reserves are in excess of many countries. Undoubtedly, central banks' printing of money has also supported global households, and individuals around the world are sitting on more than $5 trillion worth of excess savings. With so much of excess money, no doubt that interest rates are lowest in US and inflation has gone up. Right now, we have one of the highest gap between interest rates and inflation in US. Now, the question is, when is Fed likely to raise interest rates? Against earlier expectation of 2023 hikes, now people are talking about hikes in second half of CY 2022, somewhere around here. Because people have so much money, they are also spending, and corporates' inventory level has come down dramatically. There is a paradox situation in US where there are more jobs, albeit at the lower end, than the unemployed people. The gap is one of the highest at 1.7 million jobs. At the same time, there is worry on rising COVID cases in US. It is not only rising in active cases, but also hospitalization. And what we saw in April and May in India is now getting replicated in US in terms of ICU unavailability, oxygen shortages, and so on and so forth. Coming to Indian economy, headlines in August 21 has been good. Hiring touching pre-pandemic level. Some states now administering first dose of vaccine to entire adult population like Himachal Pradesh. India emerging as second most attractive manufacturing hub. Economic recovery deepening in July. Forex reserve surging to all-time high level. Exports growing by 45%. And Q1 GDP, thanks to the low base, grew by 20%. Are we out of the bottom? Answer is no. Based on the current level of demand, we are about 6% lower compared to GDP before pre-pandemic. And the same is true in consumption as well as government investments. Only export-import are now above pre-pandemic level. The business resumption index is at all-time high level, reflecting opening up of economy. GST collection has bounced back to 1 lakh crore above after a dip in the month of June. The government tax collection is fairly strong, led by corporate and income tax as well as oil tax, and this has created fiscal space for the government. Unemployment levels have come down as per CMI to just a little above pre-pandemic level. Urban unemployment is higher compared to rural unemployment. In India, for the time being, daily active cases addition has remained below 50,000. A large part of this is coming from Kerala, and vaccination is picking up pace with 3 days where we registered more than 1 crore vaccination. The market will now focus on the third wave. If third wave PMI is above 50, which is expansionary zone, GST collection remain above 1 lakh crore, and business resumption index remain above 75, then my feeling is that the impact of third wave on economic activity will be fairly limited. The real question which India has to ask is, will we live up to expectation of others? And former Australian Prime Minister Tony Abbott made a very valid comment. The answer to almost every question about China is India. Although currently not as rich as China, as a democracy under the rule of law, India is perfectly placed to substitute for China in global supply chains. Let me talk about some success of global supply chain. There was a time when India was the second largest consumer of mobile handsets in the world behind China, and yet we were importing $10 billion worth of mobile handsets. There were hardly any manufacturer in India. Government announced production-linked incentive scheme and attracted companies like Samsung and Apple's handset supplier like Wistron, Foxconn, Pegatron to India. Today, we are still assembler of mobile handsets, but roughly about 2 lakh crore worth of mobile handsets production is happening in India. Now, these companies have brought their vendor for glass panel, plastic rubber components, PCB board, motors, etc. And they are looking to increase value add. Over next 3-4 years, mobile production in India will be 75 crore handsets. Value add will be 30-35%, and we will be net exporter of mobile handsets. Next slide, please. Those of you who are from northern India will remember how Gurgaon got converted to an industrial hub for automobiles thanks to Maruti. A similar thing is happening in Sri City in Andhra Pradesh near Chennai. There are more than 120 companies making electrical and electronic components for local and export consumption. They are generating $2 billion worth of exports, and more companies are likely to set up base over there from across the world, and these numbers will grow exponentially over a period of time. Sri City will become Gurgaon of electronics in the days to come. More importantly, today, corporate India is sitting on high cash, just like global companies. Over the years, their cash flow has gone up significantly and investment hasn't multiplied, hasn't grown. And hence now we believe companies will come to invest. Coming to equity markets, the small and mid cap funds outperformance over large cap continues, led by metals and IT services. In this calendar year 2021, bearing media, almost all sectors have delivered positive return, but outperformance has come primarily in metal, IT services, and real estate sector. Retail investors continue to be big buyer of equity, whether it's primary market or secondary market. They have been allocating more towards equity market. FPIs continue to favor India. We have collected $26 billion in last 12 months, whereas they have been major sellers in almost all other markets except Brazil. The FPIs started investing in India about 3 decades back. More than 26% of all FPI equity flows, which have come over 30 years, has come in financial year 2021. Obviously, when you get such a large sum of money, next year is likely to be subdued. And now we are seeing even in FY22, FPIs have turned marginal buyers. Valuation wise, we believe it's a neutral weight equity allocation, and momentum wise, we are right now giving neutral weight based on the strong recovery in market. From a valuation point of view, historically, our market cap to GDP ratio is 77%, and currently we are at 111%. 111 over 77 looks higher, but global market cap to GDP ratio is 142%. Compared to that, 111 looks much lower. From a trailing PE point of view, we are way above our historical average of 20 at 28. And even on a price to book, we are way above our historical average of 2.9. However, when you convert this into forward earnings, numbers look very reasonable. This slide shows the profitability growth over last 4 quarters from June 20 to June 21. Corporate India has declared a profit of roughly about 7,89,000 crore. And if we round off March 21 numbers, that profit was coming annualized at 8,40,000 crores. This rapid growth in profitability from 32,000 crore in June 20 to roughly about 1,92,000 crore, even in second wave impacted quarter, gives confidence to the markets. Please look at this slide carefully. In FY20, Nifty EPS was 472 rupees and it degrew compared to previous year. In FY21, we bore the brunt of negative GDP growth of 7.3%, and yet Nifty EPS grew by 15% to touch 542 rupees. On FY22 trailing, we are roughly at about 27 times trailing earning. This year, GDP is expected to grow at 8.7%. Nifty EPS will grow by 35% to touch 732. And on a 6 months forward, we are trading at 24 times. Year after that, Street expects Nifty EPS to be about 865 rupees. And on that basis, market is trading 20 times forward. The journey of 470 to 542 happened because taxes were cut, debt burden was reduced, interest rates came down, and most importantly, cost control was used aggressively. The journey of 542 to 732 and 865 will happen also because of operating leverage as capacity utilization starts going up. At this point of time, we remain neutral weight to equity, marginal overweight to large cap, and marginal underweight to small and mid cap. At this point of time, today, we are launching Kotak Multi-Cap Fund. My colleague Devender Singhal, who is going to manage this fund, is also on the call. Devender, I will request you to kindly take through multi-cap.
Thank you, Nilesh Shah. Very good afternoon, everybody. So they say that you don't put all your eggs in one basket. Similarly, when we talk about investments into one market cap bucket, we say that you have to have investments in all the market cap buckets versus one. So the answer to this call is the Kotak Multi-Cap Fund, which is a right combination of large cap, mid cap, and small cap stocks coming together to form a dream team. We at Kotak have been able to add value to our investors consistently across the market cap buckets across most periods of time. If you look at a Kotak small cap fund, which is the offering within the small cap space, you can see the value addition over periods. Same way can be seen for a mid cap strategy of Kotak emerging equity funds and in a large cap strategy via Kotak blue chip funds. As you can see on the screen, this is not only on the lump sum basis, but Avinash, can you take the next slide? Also on the SIP route. All this has been with the trust. This has created a lot of trust within the investor community, and our equity AUMs have grown multifold over the period. In the last 5 years, from as low as 15,000 crores, we're almost 7 times now to 113,000 crores in a period of short period of 5 years. This is not only doubling our equity AUM, but increasing market shares also. When we talk about a Kotak multi-cap fund, this fund would have a minimum of 25% each in large cap, mid cap, and small cap stocks. The balance 25% would be dynamically allocated via a proprietary model, which will optimize overweights in mid, small cap, and large caps. If you see the performance, the back-tested performance of this model, the model has outperformed the benchmark Nifty Multi-Cap 500 in 11 out of 15 calendar years. Even when we look at the broader market, the model has outperformed the Nifty 500 in 10 out of 15 calendar years. This product is well suitable for any medium to long-term investments, as is the case with equity. More so with a multi-cap fund, because over the period of time, multi-caps give you a flavor of all the 3 market caps therein, and the full cycle plays out. So anybody who's looking for long-term goals like your daughter's education, your son's marriage, or planning for your own retirement, this fund is very apt. Even for medium-term goals like buying your dream house, one can look at this fund to invest. The NFO opens on 8th September, which is today, and closes on 22nd September. The benchmark here is Nifty 500 multi-cap 50, 25, 25. Nilesh sir, you want to take it further?
Yes, Devinder. In terms of other ideas apart from our multi-cap fund, I mean, clearly there are very few large cap funds where alpha has been generated consistently, and Kotak Blue Chip today is one of those rare large cap funds which has generated alpha like this over the years. The same thing is with asset allocator fund, which Devinder has managed over the years. It has delivered 16% compounded return since its inception. It's almost equivalent to many other equity funds. And most importantly, the volatility of this fund is fairly low and alpha is fairly high. At current stage, about 53% investment is in equity funds and 47% is in debt funds. This fund is ideally suitable for all those investors who just want to give asset allocation decision to fund manager like Devinder. They will decide how to invest between debt and equity. Today, there are many people who talk about funds not generating alpha, but I want to present to you a fund which has delivered not only equity return, but also alpha, which is better than fixed income return. If you see, this is like a combination of a South African all-rounder, and under SEBI regulation, we are not allowed to use their name, but I am sure the data speaks for itself. This South African all-rounder has scored more test runs than one of the leading Indian batsmen who was known as the Wall, and it has taken almost similar wickets to one of the leading left-arm Indian fast bowler. Our fund, Kotak Pioneer Fund, is delivering equity return of almost 29% compounded since inception and has delivered 10% alpha, which is more than many fixed income funds return. Some of the global funds which have done well over the years, one of our Kotak Global Innovation Fund of Fund is investing into such fund called Wellington Global Innovation Fund. And this fund has done again as well like Kotak Pioneer since its inception, generating an alpha of almost 13%. In terms of investment in gold, recent time has been of consolidation, but some of the gold bulls who had predicted better gold prices in 2016 are now talking about bullishness in gold prices. This chart probably shows why they are becoming so bullish. This is the gold prices divided by S&P 500 ETF. When this ratio is high, that means gold is expensive and S&P 500 is cheap. And when this ratio is low, gold is cheap and S&P 500 is expensive. This is almost historically lowest ratio for gold vis-a-vis S&P 500 equity in US. If we look at this debate of alpha generation, almost everyone in media and social media is showing that alpha is an uphill struggle. Mutual funds are themselves running away from active funds. Age of ETF is coming. ETF is the future of investment. And if you want to invest, please invest in ETF. There is a constant barrage of this noise everywhere. There are many new ETF players who are also comparing regular plan and direct plan without taking into account the value add done by mutual fund distributor through allocation. In fact, when we look at the data does not support the noise which is being made. This is Bloomberg research where they have found that the best returns have come from mutual fund invested companies, FPIs, which everyone wants to believe as the quality investors, their portfolio has underperformed mutual fund portfolio by about 5%. Even retail investors have done better than FPIs. So clearly mutual funds are today delivering the best performance in the market. If you look at index funds, bulk of the index funds continue to underperform their benchmark indices because of the expense ratio and transaction cost. Now compare that to equity mutual funds in Kotak family. Almost across all our equity funds, we have generated positive alpha. Even in SIP, we have generated positive alpha in most cases. One thing which people have to remember, that today you are seeing double-digit return in most Kotak equity mutual funds, but the same were negative on a 3 to 5 year basis because of underperformance and meltdown in the market. Because you could remain invested in this funds during meltdown of March 20, today you are getting double-digit returns. In fact, people who would have done top-up of SIPs in March 20, their returns would have been even better. And like the booster dose of vaccine, SIP top-up is also good for your physical health. Coming to debt market, the banking system continues to remain surplus liquidity. The fear is that will seasonal fluctuation which happens in vegetable prices, in onion and potato prices, will that influence markets' view on interest rate? Will they ignore spike in inflation caused by potato and onion prices? We believe inflation will continue to remain soft in the days to come on CPI side. The FPI have turned positive buyers of Indian debt after almost 4 months of selling. There is also possibility that Indian bonds will be included in global bond indices. If that happens, we will see more inflows coming into Indian bond market. RBI has been doing a fantastic job. They are managing conflicting things like rupee currency, liquidity in banking system, interest rates, government's borrowing program, inflation, and financial market stability. All these things put together has been managed by RBI in an excellent manner, and which is why interest rates have not shot up despite large increase in government's borrowing program. In the fixed income space, it is better to focus on carry, and the sweet spot of yield curve is at the medium end of the curve. SDL continues to give higher spread than government securities. The steepness of the curve, the gap between 10-year and 1-year government security, indicates that market is pricing in couple of repo rate hikes. Overall, on debt market, we believe RBI will be in complete control. They will be managing up move of interest rates in a calibrated manner, and 3 to 5 year segment on yield curve looks reasonable. On the debt side, one will have to invest depending upon their time horizon. And if your investment horizon and funds maturity comes in close touch, that is an ideal way to invest in those funds. Kotak Dynamic Bond Fund has done well over the years. Many investors who are looking for higher return from that kind of portfolio will have to come and invest in hybrid scheme. Kotak Debt Hybrid Scheme, which Devender is managing, has delivered double-digit return over last 5 years plus. It has also generated positive alpha. Same thing is with Equity Savings Scheme, which is another scheme managed by Devender, that also has delivered almost double-digit return over last 5 years. And even Kotak Equity Hybrid Scheme, which is our balanced fund, that also has delivered double-digit return over the years. Any debt investors will be worth progressing into hybrid schemes, whether it's conservative hybrid scheme like Kotak Debt Hybrid Fund or medium risk Kotak Equity Savings Fund or higher risk Kotak Equity Hybrid Scheme.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.